You have said often in the last year in your public speeches that the U.S. economy remains resilient. That seems to be your word of choice, that despite disruptions in August and again in December, the economy is doing fine. We see a disruption again this morning in financial markets, some numbers as bad as they've been since the 30s with the start to the year in trading. Do you see that resilience playing out again now in January?
Yeah, underlying fundamentals of the U.S. economy remain very sound. There's going to be volatility in the markets. That's kind of the nature of financial markets. The news out of China, they released some manufacturing data that was a little weaker. That started sort of a downturn in the Chinese stock market, and then that spilled over to U.S. stock markets. I'm not that concerned about that in terms of the U.S. economy, because as we've seen over the last 6 years, the U.S. economy has been growing 2 to 2.25%. There have been ups and downs over time and over sectors. But again, I think the U.S. economy has come back quite significantly from the Great Recession, and the expansion, I think, is on solid ground here.
Do you see dangers from China? Yesterday you were on a panel with Catherine Mann of the OECD, who pointed out that trade with China is, even when you account for the commodities bust, is really below levels that we would expect. When you see this downturn in trade numbers globally, does that give you pause? So,
I mean, we've built in a weakening in the Chinese economy into our forecast, of course, and that's been going on in China for a while, so it's not a surprise. In that panel, as you also heard, it's hard to estimate, right, the magnitude of the downturn in China, and a lot of economists have different estimates of it, and I think that also is why a piece of data coming out of China can have like a significant effect, because on any piece of data the markets are going to move. But we've built in a weakening path for China. I don't see that as a significant risk to the forecast, but it's certainly a risk. We're going to look at that. The actual direct trade channel between the U.S. and China is not that large. So again, will it have a direct effect on the U.S. economy? I don't build it in as a significant risk to our economy.
Well, let's turn to the U.S. You may know this, but Bloomberg Intelligence keeps what they call a Fed spectrometer. Okay. It measures hawks and doves on a scale of +2 to -2, +2 being the most hawkish, -2 being Mariana Cocha Lakota. They have you will be relieved to know, as a +1 hawk. Where would you put yourself on that scale? Well,
as I've said before, I don't really want to view myself as a dove or a hawk. I want to view myself, hopefully, other people will view me as an owl, because I've tried to, be known for making wise decisions. But, I've been saying, I think since the summer, late summer, that, I thought the U.S. economy could actually could take a rate increase. I certainly think that the gradual path of rate increases is very consistent with my view of appropriate monetary policy, given my outlook for the economy. I'm seeing my forecast is for growth to be between 2.5 and 2.75, over the next year. Which puts me a little more optimistic than some on the committee.
But it puts you slightly less optimistic than when we spoke in August, when your projection was 2.5 to 2.7. What has changed?
Right. Well, I think we've seen some data that came in that was a little bit weaker than I anticipated. So, yeah, I've marked down, I would say slightly, but not that much in terms of the resilience of the economy. But, we always continually update our forecast based on incoming information. Mm-hmm. So, for example, I do believe that a reasonable, forecast is for inflation to go back up to 2% gradually over time. Given the, most recent downturn in oil prices, again, I pushed that out a little bit, but I do see inflation coming back up to 2%.
But this fascinates me, because you're an academic and you've been following these models your entire career. And one thing that we've been seeing with inflation is that even as markets have a very slow return to 2%, way out in the future, a decade out in the future, the Fed's models, when you look at the median of all the dots, see a rather optimistic return to that 2%. What is the Fed seeing? What is the Cleveland Fed seeing that the markets are not?
Well, so let's look at measures of underlying inflation. Okay, so one of the things that you have to be aware of is that the oil price shocks affect headline inflation significantly, right? And we've been running at 0.4% on the PCE.
Sure, but if we're just talking core.
Right, so core inflation measures did exactly the dynamics that the Fed models predicted, right? As oil prices stabilized, later in the year, after the big downturn starting in the summer of last year, right, we saw the core measures moving back up. that dynamic is still there, right? And so what you're going to have like another downturn, and I expect headline inflation to stay weak for quite a while to come. But again, eventually, as oil prices stabilize, inflation will come back.